So good morning, everybody. I hope everyone's doing well. The purpose of this video is to go over some stuff on Chapter 11. I just want to mention that if you were in my class before, we're using the same textbook. So chapters 1 to 10 are on the ebook on my finance lab, so you can review those. You may still have it. The other note is if we weren't in the class, you may want to go over chapters 1 to 10. All right, and as far as the homeworks go, I'm allowing you 3 attempts to do the homework. Okay, so here's chapter 11, and it's about cash flows. And basically, there's certain words for cash flows. And let's assume you want to evaluate an investment opportunity. And you have to determine the cash flows, how much you're going to shell out, right? How much you're going to bring in. And it's very similar to you going to college, right? You have an investment opportunity, you invest in college, and you hope to get more positive cash flows in your pay for going to college. And these are called incremental cash outflows, right? The investment you make and the inflows of the money that comes in. So the incremental cash inflows, the definition right here is important, are the additional cash flows, outflows, or inflows expected to result from this capital expenditure, right? So you have you go to college and you have you pay your tuition and you expect an increase in your salary more than you would get if you didn't go to college. And let me just jump ahead. So these are the 3 that are very, very important, right? And let me just highlight these, right? You got the initial investment. This is what we're going to go over here. And you got that's the money you shell out, and this is the operating cash inflows, or the after-tax incremental flows from the project. And then if you want to terminate the project, basically that's the cash that if you want to sell off everything and you're done with the project. All right, so those are the 3 we're gonna basically focus on, and they're important. And how do we determine those? All right, so here's here are the components of the cash flow, right? Here's your initial investment. You notice it's minus 50,000. You shelled it out today. And here's the operating cash flows coming in. And here you are selling the equipment when you're done with the cash flows. So I'll jump ahead a little bit. And these definitions are important. This is a sunk cost. And this is an opportunity cost. Sunk costs are cash outlays that you've made and have no effect on the cash flows from the relevant to the current decision. Let's assume you had a company and you had a big, large field that and it was grass, okay, and you kept it looking beautiful, a nice lawn in your company, outside your company, and you would pay a landscaper. So you would sink money into keeping it looking beautiful. Right? And then one day you decide to put an extension on your warehouse, on your factory or warehouse, whatever, and basically the money you already sunk into the grass has no relevance, right? Now you got to put it in a warehouse, and you don't include those sunk costs in the project's cash flows. So that's not part of your initial outlay. And the opportunity costs, now that's another important term. Those are cash flows that could be realized from the best alternative use of an owned asset. So if let's say you still had this field, and it was you decided to build a factory, but you used to rent out the land to have picnics. Well, you can't do that no more, so you lost an opportunity costs. So you would include that as part of cash outflows when one is determining the incremental cash outflow. All right, so here's a quick example. I'm on slide 11 now, I guess. Janko Equipment is going to renew its drill press, the X12, and it purchased 3 years earlier, and this is what it cost to purchase. And they're determining whether to retrofit it with the computerized control system and take it off this obsolete piece of equipment. So the obsolete equipment could be sold today for $42,000. But without its computerized control system, it would be worth nothing. Okay, so if you take that off, it's scrap. So when you originally bought the drill press, right, it was $237,000, and that's a sunk cost, right? That was an earlier cash outlay. All right. Although Janko owns the obsolete piece of equipment, the proposed use of its computerized control system represents an opportunity cost of $42,000, the highest price at which it could be sold today. So if you take the computerized control system off, that's basically an opportunity cost you lose, right? Because you can't sell the drill press for $42,000. All right, so let me go up ahead a little bit. And the first thing we're going to do in Table 11.1, these tables are important. We're going to determine the initial investment. And that's the installed cost of the new asset, right, with installation. And then if you could sell the old machine after tax proceeds from that, right? And then the change in net working capital. And I'll have more to say about change in net working capital. Basically, it's a plus or a minus dollar amount, okay? And you'll notice it says plus or minus here. So that determines whether or not you have to have more cash on hand or less from a new piece of equipment, okay? Let's say, for instance, you basically put a new machine in, and now you have to hire someone to take care of that machine, and so now your net working capital is going to be positive, right? Because now you've got a larger initial investment. You realize you just can't buy this machine without someone to take care of it. So your change in net working capital is going to be positive. On the other hand, if the machine doesn't require any maintenance, let's say, and now you had a maintenance guy who took care of the old machine, well, you could let him retire or he would get laid off, and now your initial investment will be lower because you can get rid of that guy. So this could be positive or negative, as I said. So please take that in mind, number 3. All right, so let's start going through this example. So Hudson Industries, a small electronic company, acquired a machine tool with an installed cost of $100,000, and they're going to depreciate it. If you don't know what depreciation is, go back to in the earlier chapters in the textbook. Over 5 years, and they depreciate it by these amounts in year 1 and 2 respectively. So 52%, which is the sum of these, of the $100,000 cost, would represent the accumulated depreciation at the end of year 2. That means the book value is $48,000. How do I determine the book value of something? It's $100,000 installed new cost minus how much it's been depreciated by. So this little blurb right here is real important about depreciation, and you should go back and look in the chapters and understand how depreciation works. You're writing down the cost of something as it ages, and for tax purposes, and the government lets you do that. So you have has a book value. All right, so we look at this table here, and you'll notice here they have an item about tax treatment and assumed tax rate, and there's a couple terms that are important. All right, so if Hudson sells the old asset for $110,000, right? That means that it basically originally sold for bought it for $100,000 and made $10,000 on that, right? So it realizes a gain of $62,000. Okay, so even though the book value is $48 and it sold it for $110, the old saying is you can't have your cake and eat it too. So this gain that you picked up from selling this at such a high price has 2 components, as you can see here, 2 parts: a capital gain and a recaptured depreciation. Okay, so this is the portion of the asset sale price that is above the book value, right? And below its initial purchase price. So the $10,000 extra that you got when it was originally $100 has to be looked at as something called a capital gain. Okay, so those words are extremely important. A capital gain, and then the other 52,000 above the 100, okay, above the 48 is going to be called recaptured depreciation. This also is very, very important. So these two terms are extremely important. Remember, as I said, you can't have your cake and eat it too. If it's only worth 48,000 and you sell it for above that, well then, you got to pay taxes on that. So 10,000 is capital gain, and 52,000 is recaptured depreciation. So the total gain above the book value of 62 is taxed as ordinary income at the 40% rate, resulting in taxes of 24,800. Now, sometimes the capital gain rate and the ordinary income rate will be different. In this example, they had 40% as at the same rate. Okay. So, if you have any questions on it, always feel free to email me if you have questions. We'll just keep the questions for later chapters for later. All right. So if the asset is sold at its current book value after depreciation, the firm breaks even. So because no tax results from selling an asset for its book value, there is no tax effect on the initial investment in the new asset. Okay, so I'm going to do a couple more slides. I'm going to try to keep these videos to less than 15 minutes, so you don't get too overwhelmed. All right, so if they sell the asset for 30,000, it experiences a loss of 18, right? So that's good. They take they uses the loss to offset ordinary income. If the asset's not depreciable or is not used in the business, the firm can use the loss only to offset capital gains. Right? So that's another important thing. If it's not depreciable or is not used in the business, the firm can use the loss only to offset capital gains. So in either case, the loss will save the firm $7,200 in taxes, right? 18,000 times 40%. And you can spread those losses over a couple of years. And sometimes I sell stocks, and I have a loss, and I can divide it over a couple of years. All right, I'm going to stop here, and I'll go over this slide again in the next video. This slide is very important, and we'll go over that in the next video. All right? All righty. Talk to you again later.